we're going to look at estates. Okay, so there are two types of returns that may need to be filed by an estate. And the first one is Form 706, which is for the estate tax, which is essentially a tax on the passing of a taxpayer's wealth. Filing requirements are based on the value of the estate. It's important to note that states may have different filing requirements and thresholds than the federal. Form 1041 is the income tax return for the estate. Income in respect of a decedent is gross income the deceased individual would have received had he or she not died. Income in respect of a decedent creates both estate and income tax liabilities. IRS Code Section 691C mitigates the double taxation by allowing the ultimate recipient of the income to reduce the amount of taxes owed through an income tax deduction for estate tax paid with respect to the income in respect of a decedent. But first, we're going to take a little bit of a deeper look at the estate tax. So, Form 706 must be filed by the executor of the state for every U.S. citizen or resident whose gross estate plus adjusted taxable gifts exceeds the specific exemption, or whose executor elects to transfer the deceased spousal unused exclusion, better known as the DSUE, amount to the surviving spouse, regardless of the size of the decedent's gross estate. Estate tax is levied on the gross income and the gross estate, which includes all property in which the decedent had an interest, and that property includes property outside of the United States. Estate tax is paid by the estate before the estate can distribute assets to the beneficiaries. The beneficiaries do not pay tax on their inheritance. Since 2013, the top tax rate has remained at 40%. The 2017 Tax Cut and Job Acts increased the exclusion amount for tax years 2018 to 2025 to $10 million plus inflation adjustments. Then the One Big Beautiful Bill Act permanently raised the lifetime estate and gift tax exemption to $15 million to be indexed for inflation annually starting in 2026. And this change offers high net worth individuals and families greater certainty and flexibility for long-term wealth transfer strategies. It provides opportunities for larger lifetime gifts and the creation of irrevocable trusts to utilize the higher exclusion amounts. It is important to note that federal estate tax is not entirely eliminated. Estates exceeding the new exemption amount will still be subjected to estate tax, and again, the state thresholds may be applicable. So you might have a taxpayer that has that is within the exemption limits for the federal, but then the state may have a different threshold for filing and having to pay estate tax. So you always have to take into consideration the state ramifications. Okay, and this screenshot shows the first page of Form 706, which is the United States estate tax return. Form 706 must be paper filed, as the IRS does not currently support electronic filing of this form. And note that this is another undated form. Be sure you're using the correct revision based on the year the decedent died. Next, we'll take a closer look at some items that could affect the calculation of estate tax. So, estate tax is generally based on the fair market value of the property on the date of death. Fair market value is the price that the property would change hands between a willing buyer and a willing seller, neither under compulsions to buy or sell. There are special valuation rules that may save on estate tax. The most commonly used valuation rule is the alternative valuation date. If the alternative valuation date is elected, assets are then generally valued as of 6 months after the date of death. If assets have decreased in value, making the election could reduce the value of the gross estate and thereby the federal estate tax due. Years ago, I had a client whose aunt died. The client, yep, this is true, was an unassuming postal worker, a very sweet gentleman. He was the sole beneficiary of his aunt's estate. Well, imagine his surprise when he found thousands of Gillette stock certificates in his aunt's hall closet. She was a frugal woman who worked for Gillette as a secretary for many years. Well, my client was now a multimillionaire. In the time between his aunt's death and the discovery of the stock certificates, approximately 6 months later, Gillette's stock value had declined quite a bit. By using the alternative valuation date, tens of thousands of dollars in estate tax was saved. Special use valuation allows the value of real property to be based on its current use. And so this is another one. We're past the alternate valuation date. Okay. So another technique is where special use valuation allows the value of real property to be based on its current use as opposed to its highest and best use. Real property may qualify for this election if it's located in the United States and is used as a farm for farming purposes or in a closely held trade or business other than farming. The decedent or a family member must have used the property for at least 5 of the 8 years before the decedent's death, disability, or retirement. While we're talking about valuation and basis, I want to point out the difference between gift basis and inherited basis. The beneficiary of a gift uses the basis of the donor in determining gain of loss, while the beneficiary of an estate uses the fair market value of the asset at the date of death, which usually results in a step-up in basis. A step-up in basis occurs even if an estate return is not filed. And please note that the step-up in basis at death is preserved in the One Big Beautiful Bill Act. So that means heirs will continue to inherit appreciated assets at their fair market value.